And I negotiated this deal for about a year from 85,000 a unit down to 62,000 a unit with a very large vendor take back. And I think within 8 months, the appraisal came in at, 130,000 a door. You should put a stress test on your own numbers. Run that pro forma percent debt and see what happens.
What's your secret to managing multiple large properties efficiently?
And I think it's very important that every investor at least once, because then you know the process. Once you've been through those experiences, then if you keep doing that, it absolutely 100% will happen. You will get a deal. I don't think I've known a single person or mentored a single person who's done that and not gotten a deal.
Welcome to the Wealth Through Real Estate Show. I'm Alre Noble, and today we have a special guest, Cory, who's been investing in Canadian real estate for, I think, 24 years now. Cory is a multi-family investing expert with a portfolio that includes, I think, 14 apartment buildings valued like over $40 million. Insane. We're going to dive deep into his journey, strategies, lessons he's learned along the way. So let's jump right in. So Cory, before we get into the nitty-gritty of multifamily investing, could you share with us what initially drew you to multifamily properties and how your strategies evolved over time?
24 years sounds like a long time, doesn't it? It's interesting, the journey into multifamily. Obviously, I started like everyone else, single family, 24 years ago. So 2000, I bought my first house, Saskatoon, Saskatchewan. I actually had a suite in the basement. So it was technically a multiple unit because it was more than one, but I basically rented out the basement, lived upstairs. And then I moved overseas, and then I was renting both. So that's the first time I really became a distance landlord. Yeah. And I guess, fast forwarding a little bit, it didn't take very long. I was overseas and I was looking for passive opportunities because I wasn't in Canada. And I was like, okay, the market wasn't, going crazy then. It was 2004, 2003, 2004. The big boom of 07 hadn't hit yet. So, I was just starting to hear about multifamily. At the time in Edmonton, you could buy a building for $30,000 a door. It's hard to believe those prices today.
Yeah.
But I stumbled upon another investor, Thomas Byer, and he was pretty heavy in Edmonton at that time. He had just started to buy around 2002-ish. So I saw he had a joint venture. So I basically joined as a silent partner. And fortunately, I took a shine to it instantly and kind of became a student, you could say, and I quickly learned the difference, and I didn't realize at the time that, the direct relationship to income to valuation. And that's the main reason why I've pretty much focused on multifamily ever since.
That makes sense. Now, I want to dive into it all and break it down, share some wins, share some losses. Tell me, for all of those interested, real estate investing, is there really an upside to it? I think most people can agree that there is, but what's the most significant upside you've ever achieved on? And I know you specialize in underappreciated buildings, right? What's the most significant upside you've achieved on an underappreciated building?
Yeah, I always look for some upside in every building, but I think what you're talking about is the big, the big buzzword, where you buy something crappy and bring it up to value. I've done that. Out of all my buildings, I've probably done that 3 or 4 of them. The majority have been buy and hold, slowly improving. You get some upside, but the biggest lift I had was probably in Red Deer. I bought a building there, was 48 units in 2017, I believe. And I negotiated this deal for about a year from 85,000 a unit down to 62,000 a unit with a very large vendor take back. And I think within 8 months, the appraisal came in at, 130,000 a door. So that was a pretty big lift, but that's the biggest one I've ever done. I've had a couple that have been close. I've had a couple, 30% increases, 40% increases, but that was definitely the most significant one for sure.
Now, I know everyone's looking for those unicorns, but
yeah,
and I know that's not the vast majority of your portfolio, but what's your strategy for finding these undervalued properties with huge potential upside?
It's just a matter of being patient. Oftentimes, they're not exactly hidden. They're hidden in plain sight, I like to say. So, 2 of my best deals, one I did in Leduc, one I did in Red Deer, they were both on MLS for like a year or 2 years. They were just stale and nobody wanted them, and they were just listed at high prices. And eventually, it was just the right combination of circumstances. I was just patient, went back and negotiated. I mean, I could pull up MLS right now and I could probably find 3 buildings that are really good deals. People just slough them off. It's like, well, no, it's too expensive.
Yes.
Well, no, I mean, you got to dig a little bit, right? I've never had anyone, drop a major deal on my lap. Hey, Cory, look at this. Here's a deal of the century. No, and it never happens that way. So, I mean, there are specific strategies I use for searching for deal flow. But my general message is just to be patient and to be consistent.
I love that. Yeah, because a lot of people say, hey, you need to be a big fish and you need to know people so you can get those exclusive deals. But it's refreshing to hear you say, hey, you could find these on the MLS if you look hard enough and if you're patient enough, right? Once you've identified a potential property, what's the first thing you do? I know you have your sequence or your strategy on how you go about it. But for listeners out there who they're taking that first step, they want to start analyzing deals, they want to start finding these undervalued apartment buildings. What's that first thing you do?
Well, the first step I do is it's really nothing really to do with the property. If I'm interested in a certain area, it's usually where I have some critical mass already. I have a lot of units, so I can bring management on quickly. The first thing I really do is do market surveys. In Alberta and Saskatchewan, as you know, we don't have rent control, so rents can change a lot. In a 6-month period if you're not paying attention. So, I mean, good management companies will survey every month. So the first thing I do is, to know how much to pay for a building is I check the market. What are the rents? What are the comparable rents in the area I'm looking at? What comparable buildings are there? What's the vacancy rate? These kind of things. And, from that information, then you kind of know what to go after, right? So then I'll outline, at any given time, I probably have 5 or 6 deals on the go that I'm, negotiating or trying to, do a price point. But generally, like I said, there's 2 strategies: buy and hold, or the big, the BRRRR strategy, which is the quick value add or the quick value add. But most of the time, and on the quick value add, the building is either empty or has significant vacancy. So, I mean, it involves 2-tier financing. It's very expensive to do that now with high interest rates, but it's definitely a lot more complex. But I look at usually someone who's a ma and pa operator, right? Who's, maybe managed the building for a long time. They know all their tenants and they were just too scared, right? I mean, I bought a building in Fort Saskatchewan last year. It was the last building I bought. We literally, raised rents $300 immediately. And I think we had one person move out, just because it was so under rented. So that's the sharpest lift you're going to get, right? Because you're going to get a huge rent increase and you didn't spend the dime to get that. Now, that's fairly rare, but the momentum of the market has to be taken into consideration, but it is geographic, right? It depends where you are. Now, you didn't say at the beginning if your podcast was specific to Alberta or not. I'm kind of assuming since you're local and people
it's
watching
Canadian.
are interested. Canadian. Okay.
Canadian,
so, yeah. So for example, if you're buying in Edmonton, you got to watch out for those, 2015 to 17 markets. Because ask any investor, you probably know yourself if you were investing, it was god awful. And it went on for years. Like we had high vacancy, our rents dropped. And you talk to someone from Toronto or someone from Vancouver, and they don't know what the hell you're talking about, right? Because they didn't experience that. So completely different strategies, in rent controlled areas, Ontario, British Columbia. There are similarities, but for the sake of the example, I'm just gonna mention Alberta. So you really want to be conservative and you want to be buying. There's no wrong time to buy. There's no right time to buy. I mean, I've bought buildings when the market's been really hot. I've bought markets when the market is really low. But you can't kind of be swayed into the media. You got to have a system and an analysis method that allows you to proceed, regardless, because it is cyclical. And Alberta runs in 10-year cycles, right? We tend to have, right now we're in a huge rent push, and actually Edmonton is behind Saskatoon and Calgary by about $300, $400 in rents. So there's a lot of upside in Edmonton. But also, prices are starting to come up and, sellers are, they're asking for, next year's values today, which is, another topic. But market forces is one of the main ones that I look at, especially in the areas that I invest in, and, not to overpay when times are good. If you're buying it's 1% vacancy rate, that's not going to last. mean, you have to have staying power. You have to have dry powder to last through the tough times too.
I love that. There's so much to unpack from that. So, firstly, it's the macro side of things, and then the micro side of things for each building that you're analyzing, and we can unpack that later. But I started this off with highlighting like what's the biggest upside you've had. I feel like we won't be doing justice for everyone listening out there if we don't talk about the biggest mistakes, either you faced yourself or even just newer investors that you've come across. What are some of those big mistakes that you see?
Yeah. So, I mean, back when I started multifamily in 2004, 2005, from those years, 2005 to 2014, right? Before the oil crash happened. I mean, in Alberta, you couldn't go wrong. It didn't matter what you bought, right? You could have bought single family, multifamily, duplexes, condos, commercial, you name it, right? But I got extremely lucky on a couple of my buildings. I bought in, not that buildings that didn't have great upside. Okay, maybe they weren't in great areas. They had, they were really old, needed a lot of work, and didn't have great suite mixes. And I got very lucky on a couple of my projects that I probably shouldn't have made any money on at all. I mean, my biggest downside deal, I guess, was a chunk of land. And I think I lost money on that. It was a lake lot. So it was not really investing. It was more of a speculative play.
Yes.
But if I'm looking at my my low return multis, it's actually been pretty consistent because I have a pretty conservative approach. So even if there's not a ton of cash flow, there's not a ton of appreciation, I'm not taking on 50-year amortizations. I'm not paying with 5% down. Mortgage pay down is my most important, piece of the puzzle when I'm buying. So that I know at that 5-year point, I have options, right? I can refinance, I can sell if the market's hot, I can renew, which is actually my preferred strategy to get that debt paid down. But I don't do inner city now. I mean, inner city like Edmonton, I prefer the outskirts just because of COVID. Things have gotten a lot worse in there. But I think the worst multi deal I did was, probably one in Saskatchewan, and it was only because I sold it too soon. I didn't hold on long enough, right? If you go for a 2-year time horizon, you're going to get stung. And if you go for 10 years, as long as you have a conservative strategy, you're probably going to do okay, right? But you got me thinking now. I got to have to research which was my crappiest deal, so I can update you. I have they all haven't been home runs. I swear, I'm not that good.
And that's the thing, though, is I find it's valuable to highlight those mistakes because I mean they pave the path forward, and there's so much that you mentioned in there that I hope that I recall to unpack that in the rest of the episode. But one thing I like that you mentioned was you sort of alluded to the fact that, and I know the first question that I asked was like all fancy, like what's the upside? But honestly, your approach is time, right? I love that you alluded to that. Like the upside is in the time that you hold it down. It's in the mortgage paid on and all of that. But you touched on some of the mistakes made, some of the things that didn't go as planned. How has your approach evolved over the years in terms of managing the risk and how you manage all your multifamily properties? Now, I know you sort of mentioned already is you don't over leverage them. You're looking for that mortgage pay down. Is there anything else?
Yeah, it's changed dramatically from when I started. Like, so back when I started, I mean, I didn't really pay much attention to the condition of the building and maybe the main items, roof, boiler system, decks, parking lot, these kind of things, because I always kind of bought with the momentum, and I thought, what, this is the next guy's problem. I'm going to sell this building regardless of whether this roof, I think I can get 5 years out of this roof. Right. And I did that on a 12-suiter in Saskatoon. I did it on a major asset. This is a $5 million asset in Beaumont. I bought that one and the roof was $120,000. So, those were mistakes I made going in because those are not on the pro forma.
Yes.
So, you almost got to look at the next 10, 20 years. This is why I think new builds are popular now, versus legacy apartments. I mean, I'm not saying don't buy legacy apartments, but I did not look at those capital items. And I've talked to many seasoned investors, in Edmonton and, kind of offline and online. And even the most sophisticated ones have been bit by this.
Yes.
Like no one wants to think of themselves as, I'm the guy who goes in there and improves my property, makes it great for my tenants. I don't cut expenses, but everybody cuts expenses. Like, don't kid yourself, right? It's all about the bottom line. So then if you keep doing that, right, over time, then, oh man, okay, the roof needs to be done. The boiler needs to be done. Now all the suites are out, are dated. If you've kept your occupancy high and didn't have a lot of turnover. So I really look more at the condition now. And if it's not, I'm really taking that into consideration because, one building I bought in Saskatoon was full, right? 2016. The market in 2017 was terrible. It was 20% vacancy. My rents went from $1,200 to $800. I turned over every single unit, and every single unit needed work. Suddenly, overnight, I was competing with brand new builds that had underground parking and in-suite laundry. And I'm just like, what the hell just happened? Like, I was planning to hold this for 5 years and make some money. Now I've dumped a bunch of money into it and my rents are still low, right? So that was probably my greatest lesson learned right there. You have, there's so much, James Canal has a really good saying for this. It's deferred maintenance. But he has another word for it. There's kind of hidden deferred maintenance. But if I think of what it is, but that's something you really, really, really have to take into account. And some people, it's cheap. I'm just going to buy it because it's cheap. Well, cheaper is not necessarily better. Right?
No, it's not. It's not. I'm curious though, like how did that story end? What ended up happening?
Oh yeah. So James and I did a podcast together, and because we were comparing war stories, and he said, well, hey, like that's a great question. I can't wait to tell you the end because it's still in progress. James was talking about Edmonton, like, because he had multi there. I didn't have as much multi, and I think he had some more challenging areas. I mean, he was in Central McDougall in some areas with higher vacancy. And he said he told his investors, okay, we have a worst case scenario. And what happened was way worse than any possible worst case scenario. So, I mean, suddenly Boardwalk and Main Street, they were offering 3 free months of rent and no security deposit. 3 months of rent, no security deposit.
How do you compete?
How the hell does anyone compete with that? Yeah. So anyway, I've talked to a few guys about this. I mean, Mike Ponte, he was giving like big screen TVs away to tenants, etc. So me, the only thing that saved my ass is I had a healthy reserve fund. I had about 7% of the property value, about 150 grand, and that saved me. 2 things saved me. I got really low CMHC rates when after COVID, and now it's a completely different story for what could have sunk me. So every time I turned over a unit, I had to renovate it. I had to make it look like the new one that had all the fancy stuff just to get a warm body in there.
Yeah. So
when things started to swing the other way, I did a bunch of landscaping too. It's like, oh, now in Saskatoon, the vacancy is like 1%. So now I've raised my rents from, $800 for a 2-bedroom to, $1,050, and then to $1,250. And now I'm raising them to $1,650. So, now it's like what a difference, some time can make. So that's the long-term time horizon, right? So when I came in 2016 to 2021, those were the worst years to invest on the prairies ever. Not ever, okay, not outside of the 80s.
Yeah.
But if you pull up a graph of, vacancy versus rents, that 5-year period was not where you want it to be. Sure, if you bought there, but if you bought in 2014, you were buying at the peak. You're probably maybe still underwater today, but the story's in progress. The building is now doing very well. Rents went from like, $16,000 a month on a 24-suiter to, almost $30,000 now. So the building has, and I overpaid a little bit at the beginning too, because, 2015, the oil crash, the effects of the oil crash weren't fully felt. And I kind of jumped in too soon. I thought, oh, the market's dropped 10%. This is a great time to buy. Little did I know it was going to keep going and keep going. That's why the long time horizon is so important. So, fast forward to today, I have a really strong generating cash flow building. It's basically completely renovated and the market is strong, right? And I have a healthy reserve fund. So, the 5 years, my investors were very patient, because you could get away with that before, right? 2003 to whatever it was. Yeah. No, now if you're buying a multifamily deal now, it's 10 years. I tell my investors, look, we're in this for 10 years, and then we're going to do good regardless. So I think we're at about year 8 now. So we're coming to the end. But that was definitely the most stressful time of my life because I had that happening on 5 buildings at the same time. I had 3 in Saskatoon, and I had 2 in Edmonton. I think I had maybe 4 in Edmonton, and they were all negative cash flow sucking alligators at the same time. So basically everything I was making on my real job was going into just keeping these properties afloat. And I blew through literally all the reserve funds. And it was like James said, the worst case scenario was way worse than that. So it's tough to plan for worse than the worst case. But that's why investors like you and I that have been through Alberta in the last little bit, I mean, we're kind of battle tested. I like to think of it that way.
Yes. Yes.
Patience and persistence. Because now I think things are going to be really good for the next. I mean, we've got at least 2 or 3 more years of upside on this boom. And then if oil starts to come back, it could get even better, right?
Oh yeah. We're in a fantastic season. I want to highlight something though. You had so many go wrong at the same time. For people out there who are looking to get started or potentially looking to scale up, but that's like a big fear for them. What's your secret to managing multiple large properties efficiently?
Yeah, it comes down to management. I know a lot of people, even sophisticated investors, a guy I know really well, that they micromanage their property manager. Like you have to get one that's good and trust them and let go. And I mean, for me, that was the toughest thing. I didn't want to hear bad news from my property manager. I didn't want to hear that I had to lower my rents. I said, what, are you crazy? I'm not lowering my rents. No way. And what happened? I ended up with a nearly empty building. Right? That was another huge mistake. And then I was spending money to renovate units to get someone in at that low rent that those other guys were going to stay for. Right? So I was pretty cocky and arrogant there. But now I run this large portfolio and I talk to my property manager, maybe once every 2 weeks. I'm not on daily calls, sometimes once a month when I'm on vacation, just to get an update so I can update my investors on what's going on. And it's taken a while, right? Like, fortunately, I have a very good manager in Edmonton, in Braden Equities.
Yes.
Saskatoon has been an absolute nightmare trying to find good management. And that cannot be overstated, right? And management is a tough job. It's a very, very tough job to be a property manager. Any property manager will tell you, right? Because their service is invaluable. They know the market so well, and they do surveys like all the time. Right? They see things happening long before I ever could. Now, when I used to live in Edmonton, it was crazy. I would drive by my properties all the time and kind of, spy on them. Oh, what are they doing? And then question what they were doing and stuff. And it's just like, that's a rookie mistake, but it's naturally what most, new investors will want to do, right? Because it's like, or you go through your statements and it's like, oh, well, they charge me this and this and this, and they're ripping me off, and I'm going to fire them, do it myself. And little do they realize just how much it takes to run a building. And it's not easy. It's just a matter. It's not a matter of I'm just going to, pull the yellow plate pages and find a manager or ask someone for a reference to another manager. It's very much like buying a building, right? Like, you have to develop relationships and rapport with the good ones, because the good property managers, it's a two-way street. They don't want you.
Yeah.
I mean, if you're a crappy investor or you're not willing to put the money in, they'll fire you. No problem. So it's a two-way street that way. But leaning on management, especially in the last, I want to say like since COVID, that has really elevated to the next level, because now I have strong cash flow. My stress level just has gone way down. I've been able to focus almost all of my time on acquisitions and joint venture partnerships with raising capital, as it should be. I mean, Some investors love the management side of it. They love to go and get in fistfights with tenants or, whatever it may be. But, that's not for me.
I love that though, because when you want to scale and you want to take it to the next level, like, the biggest thing holding you back is delegation, as focusing on those high producing activities and staying in that lane.
Yeah.
What advice do you have for people who are they start in this, like, hey, I'm trying to find a good manager. What do I look for? Build rapport with them. How do I know they're going to be efficient at what they do? And how do I prevent myself from micromanaging the manager?
Yeah. That's a tough one. References are good. Well, first of all, you have to decide of where, at what point, at what scale do you need one? And I think it's very important that every investor self-manages one property at least once, even if it's a condo, even if it's a basement suite or a duplex or something, because then you know the process. You understand, what it's like looking for tenants, screening tenants, having to evict somebody. Once you've been through those experiences, then you're better suited. If you've never invested in real estate and you're just looking for someone to, I'm going to buy a piece of crap asset. Now I want you to raise double the rents and I'm not going to spend any money to do it. Right. Because a lot of investors do that. Right. They just think these guys can, perform miracles, put lipstick on a pig, essentially. Right.
Yeah.
But I think it's all about how much your time is worth to you. I mean, if you've got upwards of 10 units, 10 singles, you probably want to start thinking about it. I absolutely would not recommend self-managing an apartment building unless you lived in it and you wanted to do that.
Yeah.
I do know people that do that and they're happy with that. But when I talk to them, that's literally all they're doing. Like they're carrying a phone around and they're answering calls like all the time. Right. So you want to ask other investors, you want to ask investors like myself. I mean, who do you recommend? Who do you use? I mean, I'll tell you. I mean, I'm not hoarding any of that information. Right. And it also depends on what asset class, right? If you're doing commercial, there's different property managers. And so my particular property manager, their business model is volume. Okay. So they handle a lot of units with kind of one cookie cutter model, which is very stress-free for me because I buy one certain type of asset. I buy walk-up apartment buildings. But if I'm going to buy something that maybe I wanted to do a super suite renovation, or maybe I wanted to do a furnished renovation, right? And maybe get double the rent, but it's more management intensive, or I want to do weekly rentals, et cetera. Well, that management company is not the right one. Yep. Now you're in a different model altogether. So it really depends on what asset class, and then you have to find out, who's managing. And obviously, the bigger ones, Main Street and Boardwalk, once you have enough doors, they bring all that in house. That's the long, short answer.
No, I love that though. It's the honest answer. Question for you. It seems like you've definitely figured out what works for you and you've stayed in your lane. Now, not all people are like that. Like there's that shiny coin syndrome and there's a bunch of strategies that work. What's kept you sticking with, hey, this is what works for me. Those other strategies might work, but I'm going to stay doing this.
Honestly, there's been times like in the last couple, when things were really bad during COVID, when I was like questioning like what I was doing, and I was like, oh my good gravy. And just what I've seen, especially in the last 5 years with social media and people posting their deals, posting their JV pitches, the stuff that they're doing, the how they're raising capital, they're buying with ridiculous leverage with no reserve funds. And I don't like to call people out. I don't like to call out bad operators, but there's a lot of really bad operators out there. And I'm sorry, when you're dealing with other people's money, or you've never dealt with other people, or you've never used your own money in a deal, and I don't like to call that out. I started teaching people my method. That was kind of my way around it. I used to blog on my rain space a lot. When people would say things that I would disagree with that I knew was going to get them into trouble, I would usually say, look, this is what happened to me. So that's kind of why I've stayed in my lane, so to speak. But I'm also a lot more conservative than I was, right? Yes. And I'm buying different assets. I mean, I'm not buying 12, 14 suiters anymore. I'm looking at 100, 200 suiters now. I have the capital raised to do that. I'm just biding my time. I'm patient for the right deal. I'm buying in different structures. I'm doing LPs, looking at LP and REIT models versus, single corporation, unanimous shareholder agreements, which is how I've typically bought my assets. But it's been baby steps along the way. I'm kind of like a turtle in third gear. 24 years. I've just kind of gone, and even the ultra conservative view that I've taken, like I told you, I almost got in trouble a few times just because of huge market dips that I wasn't expecting. Yeah. And, Ontario investors listening to this will be like, oh man, this is why I'll never invest in Alberta. But because it's so risky, right? But for me, I don't think it's like that. I think as long as you didn't pay too much, as long as you have a healthy reserve fund, you have a quality asset and you're not over leveraged, I think you're going to be able to sail through everything if you have good management.
I love that. I want to highlight for people who potentially don't understand the whole structure side. Why are you changing it? Is it because you're scaling up to bigger units? Is it so? What does that look like? Why that decision?
Well, you're essentially forced to, right? Like,
yeah.
My cookie cutter model was so when you take on a JV deal, you as the expert are expected to basically do everything. Yeah. The money partner, silent partner is expected to do nothing and get good reporting and make a lot of money, right? That's kind of what you've promised them. Now, obviously, the more costly the structure to do that, the more risk to the deal, right? Or the more fees you're taking, et cetera. So, early on, I kept it was just a simple corporation, and I did not buy CMHC. I was not a fan of CMHC. My first 6 apartment buildings were all conventional financing, 75% loan to value, for the simple reason that I did not have to get my investors to sign personal guarantees for the mortgage. They were completely. Now, of course, there is some potential liability there. I don't want to say there's no liability for silent partners in a corporation with a conventional mortgage. That's not the case. But if you're going CMHC, depending on the recourse level, they're going to ask you to either have half of your participants or all of them sign guarantees. So I was like, I'm not doing that, because then I'm not going to be able to ask for nearly as much of the equity side. Right. Yeah. And then, what do they need me for? They can go buy their own building. And so that's just kind of what I'm gravitating back to. Now, that's been the real challenge in the last 3 to 4 years, because those conventional deals now, because I was borrowing at 3% interest, 25-year amortization, I could pay down enough principal in 5 years to deliver a 30% return all day long, even if the property never went 1% and there was no cash flow. So I was very happy with that. But since COVID, a couple things happened. The conventional lenders just they just disappeared. They started calling all their loans back. I had a $2 million loan. I was trying to renew, and they're like, no, we're not doing anything for less than 10 million now. We want our money back. It's like, oh, okay. Well, now I'm scrambling for new financing. So this is why largely CMHC now has the monopoly that they have in multifamily. But it's created just an absolute gong show of people buying with 5% down and, high leverage, long amortizations, not paying off any principal. And it's too early to even see, because you got to get to the end of your term to see how risky that was. Can I even renew? Can I refinance? Do I have to sell this thing at a loss? I was never comfortable with long amortization. So, now my structure today, if I'm buying 100 units, I'm doing it in a limited partnership for a couple reasons. I don't want my investors to sign guarantees. I want to shield them from as much liability as possible. And I want to maintain the 65, 70% leverage that I'm comfortable with, because I know what happens when you over leverage. So when you go to larger assets like that, that's what you have to do. And if you've been following the REIT space, they've just been absolutely pummeled since interest rates started going up because of their debt they're carrying, even though a lot of them are really low debt. So that will come back. I think REITs are a good play. But for myself personally, I really like the limited partnership model. It's affordable. It's a great way to raise, probably up to 10 million, whatever you're trying to raise. If you raise 10 million, you probably buy 30 million of assets, buy yourself a nice, couple 100-unit building. So that's what I'm shooting for right now.
For everyone listening out there, you can hear the advice is sage advice from someone who's been doing this for 24 years. It's that's why you have the longevity that you have. Now, for people who are just getting their feet in the door and they want to use leverage, but they're also scared of the risk, and they want to be a little bit safer with how they crunch their numbers. What do you personally, because I know it's also an individual thing, but for you personally, what do you recommend for either yourself, your students, for a good, healthy reserve, as well as how far they should push that leverage?
Yeah. So, when the bank underwrites your deal, you want to do your own underwriting. I have a good calculator I can share with your viewers if they're interested in it. But so the bank is going to do their own underwriting, but you should do what the bank is doing when you go to buy a house. You should put a stress test on your own numbers. So if they're qualifying you at 5%, run that pro forma at 7% debt and see what happens. And then figure out how much you owe at the end of your term. And then what happens if rates go up 3%? What's going to happen to my cash flow? What are my payments going to look like? So that's one of the, the smartest things you can do. I used to say 5% a reserve fund, 5% of the purchase price, but now I'm doing like 7%, 7.5%. I can hear people cringing in the background. It's like, wow, I'm not going to leave 100-some thousand in the bank, and my return is going to go down, right? I want to buy this as skinny as possible. I want to buy 5% down so I can get 20-to-1 leverage and just hit home runs out of the park. Well, I know a lot of people who've bought into that scam, that MLI Select program, and they're sure regretting it now because they're highly leveraged, right? A long amortization, not the greatest interest rate, and they can't raise their rents. And no one wants to buy their building because no one will buy it saddled with that ridiculous debt.
Yes.
So you really want to look at that. But reserve fund, if I had to choose between reserve fund and a shorter amortization, obviously the reserve fund. But I can tell you, you can blow through a reserve fund faster than you can blink. If you have, one vacancy, if you got to renovate that unit, it's probably, 12, 15 grand, on a 12, 15 suite, your whole monthly remittance is gone. Poof. And if you're doing that a few times, or your roof and boiler goes, you want to have, I think it was $100 per unit per month of free cash flow. So on a 20 suiter, you want to try to have $2,000 left over after everything, your mortgage payment. And that's pretty tough to do today.
Yeah.
Because prices are so high. But then when you go to buy a multi, the seller wants this. As a buyer, I want this. So the seller obviously needs a reason to sell, right? Especially if he's got it paid off. So he needs a premium over and above what it's worth. As an investor, I need to get something more than what the current financials are saying. So you got to try to find that comfortable medium. And most apartment buildings trade that way. It's just, it takes the time and patience and a balancing act and knowing exactly, how the deal is going to manifest itself. But, I've seen a lot of people, I've overpaid myself. I've over leveraged myself. It's a stressful position to be in, stressful position for investors to be in. And I'm watching this, this condo debacle unfold in Toronto right now. And, a lot of investors are getting hurt, unfortunately. And I know everybody wants to make money, but, you got to manage your business smart.
I have a question for you. So when you looking to acquire, like you actively looking to acquire, what do those spaces in time look like? Because real estate it's an action game, but it's also a patience game. And balancing that, like, am I not doing something right? If as an investor, I'm looking for these deals, I'm not finding them. How patient should I be? And follow up, what should those reps look like in terms of putting in offers, negotiating? What does that typically look like for you? Like just off the bat, like I put in X amount of offers until I end up even getting a deal accepted.
It's like applying for a job, right? I mean, it's a lot of work that you might not get anything out of the ass end of it. It's really putting out a lot of seeds, right? But I can tell you this much. I've mentored a lot of people, and the guys that are the most successful, they have a plan and they stick to it, and they don't get discouraged. The best thing you can do, the single thing you can do, is tell everyone what you're looking for. If you want to buy a fourplex, you scream it from the rooftops. I'm buying a fourplex.
Yeah,
that's the best way. Tell people what you want. The biggest thing is to be awake and ready when that opportunity lands in your lap. And I say when, because if you're doing this on a consistent basis, if you're going on MLS, you're filling out the email things and getting pro formas, and you're talking to realtors, telling them what you want, hey, I got all my ducks in a row, I got my investors, I'm not wasting your time, etc. And, you go through all the proper channels, you get on all their email lists, you follow up, you walk neighborhoods, you talk to people, you shake hands. I'm not saying you got to do 80 hours a week, but you should be consistent, put in at least 3 or 4 hours a week. If you keep doing that, it absolutely 100% will happen. You will get a deal. I don't think I've known a single person or mentored a single person who's done that and not gotten a deal. Yes. Right? So that's the first thing I can say but it is very difficult not to get discouraged, right? Because a lot of people are just fishing. They don't really, they're not really serious about selling. It's tough to find a deal. But then again, it's always been tough to find a deal.
Yeah.
But I've never had problems finding a deal. Those three kind of oppose each other.
Yeah.
It's, how do I say that? It's not difficult. It's just, rare isn't even a bad word. Rare is even a bad word because there's an abundance of deals out there. It's like the saying goes is Alberta, the streets of Alberta are paved with gold. You just have to bend over and pick it up.
Yeah.
And that's true. There's deals everywhere.
Absolutely. Deals are always to be found in every market, in every cycle. Now, I have a question for you. So a lot of what you said there, a lot of those actionable items and those skills that you work on can be translated into raising capital as well. Now, for someone who's maybe they've dabbled in the residential side, but they're looking to take the step forward into the multifamily side, and they're like, how does that pan out? Should I focus on the raising capital first? Focus on the deal? That chicken and egg situation. Like, find the deal, you'll get the money. Find the money and then get the deal. What do you recommend for people?
I do a hybrid. I mean, it depends who you talk to, right? It's a great question, right? Like, I love Terry Peranich in Edmonton. He's probably my favorite investor. He's like, screw raising capital. He's like, go out and spend all of your 100% of your time finding a deal. Drive for dollars. He says, driving for dollars. If you find the deal, the money will come to you, right? And then I hear the opposite from other people. It's like, no, don't do that because it's like so much stress. And if you don't have that raised, you have tight timelines on your deal, etc. So what's the right answer? So
right.
For me, what I did with my first JV is I kind of already knew who my partners were. I started conversations early. It was a 15-suiter I bought in Edmonton near Nate. So I paid $93 a door. I think we sold it for almost $130 a door, in 5 years. So it was a good 5-year return for my investors. And basically I knew all the people and I talked to them over and over again. I needed $450K. I think I'd raised about $600K in soft commitments. So you want to try to get those soft commitments.
Yeah.
You can get, expression of interest letters, etc. But I'm at a point now where people just know that I'm extremely particular in my deals, that raising capital, I think the longest it ever took me to fill a deal was 2 weeks. Usually my last deal was filled in 1 day. I did a webinar and it was $750,000 and we raised it in the first night. Now, not everybody, it's not going to pan out like that for everybody.
Yeah.
I do not recommend raising capital until you've put your own money in. Now, I've seen it done before. I've seen it done by some sophisticated investors, and it can work, right? If you time the market right. The last 20 years in Canada has been a bull market in a lot of places. You really couldn't go wrong. But I would really recommend, putting your own skin in first. I mean, I did my first 2 apartment buildings with my own capital because I didn't really know what I was doing. I made a ton of mistakes. Like you said, I was micromanaging the property manager. I bought a building that was all, tiny 1-bedrooms and bachelors, needed work. A bunch of stuff I just didn't know. Right? I didn't know what the word upside meant. I didn't know you could have one apartment building on the same block as another one, and one's an awesome investment and the other one is a dog. Yeah. I just didn't know those things back then, right? So raising capital, you get some experience under your belt first, but just have those conversations, right? And it can be a little bit uncomfortable, but just do a webinar or something, and just say, hey, I'm interested in raising some money. These are the deals I've done. What do you guys think? But chances are, if you are, it's probably the people you already know. Yep. Some people start with friends and family. That's what I did. Now that is its own slippery slope. Some people do that. Some people don't. I think too much emphasis has been put on raising capital now because you got to have a really good reason for doing it. And raising capital so I can become, multimillionaire and buy 100 properties isn't a good enough reason. The reason really needs to be of, look, I've had some success here. I've done this the hard way. I think I got this figured out now. And you know what? I can help this person. This person can give me money. This doctor or lawyer who's too busy. Hey, I'm going to show them how, hey, I can do this for you. Because it's not a passive investment, no matter what they say is passive. Anybody who owns a rental property, there's nothing passive about it. You're there, especially if you're self-managing.
Yeah. So
it's more of an invitation, to participate. I think of it as an invitation to participate versus, I'm soliciting for money. If you think of it like that, that's the wrong reason, right? You're inviting people to contribute in your amazing deal. And when it feels right, it feels right. You have to have a certain level of experience, a certain level of confidence. Because no matter what, you're going to have uncomfortable conversations with the people you invest. Times change, things change. People get divorced. People, they like you one day and don't like you the next. So you got to also choose your JV partners carefully. You don't want to raise your money from just anyone too. So I've seen it done incorrectly a lot. I've seen it done, correctly a lot too. So it's just something that I would just emphasize again. You need a really, really good reason to do it, right? Like you need a good reason to choose this property over this property.
Yeah. So based on our conversation, I'm seeing a lot of overlaps, like on finding a good property manager, on finding the right building, on raising the capital and finding the joint venture partners there. There's a lot of overlaps and skills that you build that will serve you in all those different avenues. Now, you mentioned, you don't just want to just partner up with just anybody. Right now, given the 24 years of experience, what are some things you look for when potentially partnering up with someone? What are some potential yellow flags, red flags? What are just some requirements in general that you're like, I won't touch it. Even if you bring in your money, I won't take it.
Well, I mean, I'm not going to take someone's last 50 grand, right? If they can barely get in there, that's kind of goes without saying.
Yeah.
But I like people who, they're entrepreneurs themselves. I have a lot of people, one guy, owns a car dealership. I like to hire net worth individuals, especially the ones that were entrepreneurs that weren't necessarily born with money. They had to work for it. They understand how it works. And, we get along really well that way. There's some red flags right off the hop, but usually those people, they'll watch my YouTube videos and they'll see my style and they're not really interested in investing with me anyways. Yeah. So I tend to attract the people that I want to be in those deals anyways. But yeah, I look for, busy professionals, usually doctors, lawyers, the ones that don't own their own buildings themselves, because a lot of them do. People in those industries, other real estate investors, that are doing single family commercial. I've invested in other deals too, right? So I like to invest in people who have at least some level of experience with real estate, because it's a unique investment. Sometimes it's not as sexy as it appears. So I like people that have some experience. I also want them to be able to invest and not have to rely on any cash flow back for a 10-year period. So you got to be comfortable enough to stroke $100,000 check, $200,000 check, and not see that money for 10 years, and know that I have a solid plan to do that. And I have a track record of doing that consistently. Right. So, I mean, if you're looking for a quick flip, or I get lots of those calls too. I had a guy call me from England one time because he saw my Red Deer deal. And literally the first question out of his mouth is, hey, I got, X amount of dollars. I want you to get me one of these deals. Let's do one of these deals together. Well, yeah, no kidding. I mean, get in line, right? Like, right. I mean, what can I say? I'd like to invest my own money in my deals, but I'm often, shut out because my subscriptions are filled. They fill up so quickly. And now I've talked to a lot of investors in Eastern Canada too, multifamily, and the market dynamics now, the markets with being so strong, with the rental markets being so strong, we've been a lot more cautious, on what we've been buying. So we haven't been buying as often, but things are looking good now. There's several deals that are potential deals on my plate now. Something's going to come soon, but it's been a gradual, slow process, step by step over time. Right. It certainly didn't happen overnight. And I'm not saying it's going to take you 24 years to get where I am, because people can do things a lot faster. I think there's just systematic ways to do it. There's definitely some red areas. There's gray areas that you should just not go into. Yeah. And I see people doing shortcuts all the time, and, sometimes getting away with it and sometimes not. But I think, especially when you're using other people's money, I mean, it's okay. It's okay to lose your own money. 100%. You can always make that back. It is absolutely 100% not okay to lose someone else's money under any circumstance, right? But it happens.
I 100% agree. 100% agree. Okay, so you've highlighted your ideal investor profile, tenant profile for your buildings. Is it like an ideal tenant profile that you aim for?
Yeah. So I used to invest, in the cities in Edmonton. It's gotten a little rougher. I've had a lot of, vandalism and a lot of problems with, like bed bugs and stuff like that, the stuff that's really makes it management, intense. So the first thing you look at when you pull up an operating statement is you look at how much is in glass replacement for vandalism and how much is pest control. Those are the first two lines of it that I look at. It's like, oh, I can tell right away. So I like the outskirts. I like the areas, obviously, like Beaumont, Leduc, Fort Saskatchewan. Those areas tend to be a lot stronger. There tend to be blue collar workers. And, Edmonton is an area that people generally make pretty good money, compared to British Columbia, Kelowna, where I live. The incomes are substantially lower than they are in Edmonton. So I like blue collar workers. I like to go to my buildings during the day and find them empty because people are at work. I do have, some that aren't. It doesn't always work that way, but that's my favorite tenant. I have a lot of students too. I'm a big believer in students and blue collar, but I basically do, the nicest renovated suite that I can for that price point. Yes. And our rents in Edmonton are still, despite the fact that I just pulled the stats yesterday. I think Edmonton is up 16% year over year. Saskatoon, where I am, is like 25% year over year rent increase. And we're still the lowest in the country. So there's a significant gap yet to fill. Now, I'm not saying we're going to just jack our rents to Vancouver, Toronto levels. But if you think of it in terms of how much people make and what's available for rentals, what I'm asking is reasonable. So I like to keep my buildings, well renovated. I don't buy in the cheaper areas. I don't like the Black Triangle of Edmonton. You can manage in there. I do know people who've done well, but I know those stories are rare. Like I'll be honest, unless you're Tony Soprano, you're taking a goon squad with you to collect rent. A lot of those people in those rough areas, they're rough themselves, right? They manage it well themselves because that's, landlord tenant board. Yeah, go ahead and go there. They'll just throw their stuff out on the lawn. I don't want to run my business that way.
No, agreed. And that's the importance of knowing your tenant profile, knowing where you want to invest, knowing the type of tenants and your management style. Honestly, this has been so insightful. I feel like we could keep this conversation going for a couple of hours, to be completely honest. Yeah. I didn't even get to unpack as much as I wanted to, but oh man, this has been valuable. I know the audience found this valuable. I know you mentioned a calculator. If you want to leave that or whatever contact info you have, I'll leave it for all the guests down in the description below. Because I'm sure they're going to want to follow you. You have a YouTube channel, all that. I'm going to push all of that. Guys, everyone listening, be sure to go and subscribe to Cory. He puts out a ton of good value. And as you can see, he's been doing this for a very long time, hasn't been wiped out. So evidently his strategy works. Cory,
I'm still here.
Thank you so much for sharing your experiences with us today. This has been fantastic. For those people who are potentially driving and they're like, yeah, I can't go to the description now, Alray. Is there any way, where's the best place for them to reach you?
I'm not on social media much, but, you can email me, but I'm on Instagram. Send me an Instagram message or a Facebook message. altonequities.com is my website. You can check out, my profile there and my deals, etc. So that's probably the best way.
Well, thank you to all our listeners for tuning in to the Wealth Through Real Estate Show. Don't forget to subscribe and leave a review if you enjoy this episode. And until next time, keep investing and growing your wealth. Before you leave, if you like this episode, don't miss the one with Danelle Chase on, where we talk about the tools and the tactics that separate pro investors from the rest. This is your host, Alray Noble, signing off.